Good morning and welcome to this Monday, June 29th edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. We do have a little bit of mixed futures this morning as we start a new week and get ready to close out the first half of the year. Last time I looked, Dow Jones Futures up a little over 100, Boeing getting a little bit of lift in pre-market. A lot of the stocks that were hit hard back in March and April have really been hit hard again here over the past couple of weeks, at least on a relative basis. And I wouldn't be surprised maybe if we get a little bit of, maybe a little bit of rotation back into those stocks simply because many of them have come back down to some key levels. And I'll go through some of the sectors that struggled back in March and April and kind of show you what I'm talking about in terms of some key support areas and trend lines. These are going to be things we're going to want to watch. But before I get into all that, I do want to just make sure any of you who are, fans of the show, maybe that aren't members at EarningsBeats, you can subscribe to our newsletter. We have a free newsletter, EarningsBeats Digest. Just go to our homepage at EarningsBeats.com, type in your name, email address, hit the subscribe button, and you'll be added. No credit card required. Just enjoy 3 articles a week, Monday, Wednesdays, and Fridays, typically out around the time the market opens, maybe a little before, occasionally maybe a little bit after. But for the most part, we try to get that out before the market opens, and just focuses on relative strength, earnings, things that we need to be thinking about when we consider our trades in the market. Okay, let's go ahead and take a look at what happened on Friday. And really last week, because we struggled. The market overall definitely struggled, particularly the second half of last week. You can see the Dow coming back down to around that 25,000 level. That was where we topped out back in April, as you can see. So we made that breakout. We came back down, tested that level. We bounced, came back down again. And now there's the 50-day moving average sitting at 24,925. So we've got pretty good support in this area. I'd like to see the market hold here. I don't know that it will, but it kind of makes sense if you take a look at the trend line here, along with the trend line. I'll tell you what, we'll take a look at that in a little bit. But S&P 500 also down on Friday, down latter half of last week, fell about 2.5% on Friday. The NASDAQ got hit pretty well as well. We've seen a lot of relative strength in NASDAQ shares, but that was not the case on Friday. Many areas that had been strong in the NASDAQ, areas like consumer discretionary, especially communication services, the XLC really had a rough time. You can see down here, XLC down 4.4%. This houses the broadcasting and communication area, or broadcasting and entertainment, and then also internet stocks are in this communication services. And of course, Facebook, Twitter really got hit hard on Friday, coming under a lot of scrutiny, that whole area of the market. And so you can see a pretty big drop on Friday in the communication services area. Mid cap, small caps also down, 2 to 3%. Everything was down in that 2 to 3% range in terms of our major indices. And then the sectors, all 11 sectors were down. All 11 sectors were down at least 1%. But you can see these are the ones that led to the downside, starting with communication services. Financials also down more than 4%. 10-year Treasury Yield's been pulling back. That's not helping. And then, of course, banks had their stress test last week. So some of the banks got hit pretty good at the end of last week as well. Energy, crude oil still hanging up there, not too far. I saw it was up a little bit today. But it's still up there near about $40 a barrel, just under $40 a barrel. So even though it's pulled back, I'm kind of looking for energy maybe to hold right around this area. Waited to get it through $40. We got it. We had a nice pop, and then we come all the way back down to this 50-day and price support down here at the 36.50 area. But we were up earlier today, this morning when I looked. Discretionary, as I mentioned, also down 2.3%. Staples down 2%. So some of the consumer stocks getting hit on Friday as well. All right, 10-year Treasury yield. As far as economic reports go, only one coming out today. At 10 a.m., we'll get the May pending home sales, looking for an 11.3% increase in May. But That comes off the heels of a 21.8% drop in April. So we're definitely going to rebound. I'd be shocked if we had a negative number, but the question is how much do we rebound? Had some pretty decent numbers coming out of the home construction area. And also keep in mind, with this 10-year Treasury yield down as low as it is, this is a good sign for home builders. I mean, if the economy continues to strengthen and jobs return, well, of course that's a question mark to the extent, what's that extent going to be? But assuming that we keep rates low and jobs do return, you've got really a good environment for home construction. So it'd be interesting to see how the group responds, how the 10-year Treasury yield responds to the pending home sales report comes out at 10 a.m. All right, I'm going to take a look today, and talking technically, I want to go in and look at some of these charts, just the major indices, the major sectors. And I pull up a lot of times relative charts. I'm just going to look at the absolute charts and just show you some of the things that I'm trying to keep an eye on here. So the S&P 500, a lot of times, when I see these pullbacks, we know where the 50-day is, we know where the recent low is, we know where the breakout was. And so 2950 to 3000, I can just kind of eyeball this chart. And I see these, this prior double top around 2950, and we break out, and we keep moving up. So I've got to believe 2950 provides us some pretty good price support. Recent lows, 2970 to 3000. There's your support. Then you got 50-day moving average, 2980. All of these things are important. Maybe one thing that doesn't, if you're a technician, maybe one thing that doesn't necessarily hit you right away. I always like to try to look for channels. And originally, when we first started up this uptrend, you can kind of see that there was maybe this channel here, something, I don't know, something like that. I'd have to drag the line, but that slope, that percentage gain cannot extend for very long. When you go from 2,200 to 2,900 in 6 weeks, that's 30% in 6 weeks. The market's not going to keep going up 30% every 6 weeks. So these types of channels are definitely destined to break down. And a lot of times folks will look at this and say, oh, there's a breakdown, that's bearish. It's not bearish. It's just, it's impractical. It's, we're not going to keep this kind of a trend going for long. So you've got to try to keep an open mind when you do break down that some of these trend lines are going to change. These channels are going to change. And I think when you start getting more tops, see, I mean, when we connect here, we had 2 tops. Here we have 1. Actually, if we wanted to start here, we could do a 1, 2, 3, 4, 5. That's more of an important trend line. And again, even this one, when we're talking about going from 2,200 to 3,000, we're still talking about over 30%. And we're talking about doing it in 3 months. This isn't going to extend forever either. This is going to be a pretty significant slope, but it can last for a while, maybe until it gets us up to the 3,400 level. So when I look at this, I just kind of want to grab this and then drag this down and say, okay, there's one possible area. And then if I drag it again, I could say, here's another one. Now I'm just going to extend this, just kind of eyeballing it, but something like that. So when I look at a chart, I'm thinking, okay, here was our upper trend line. These are possible lower trend lines. Well, we're right at one right now using this low. Now, if I had this down here and this low had touched, had I had 3 separate tests, I would feel even better about this trend line holding. But I really don't have any. So what I'm doing is I'm looking on the S&P 500 at the double top right here, the breakout. We haven't gone back down below that level. And then you see this recent low right here. I'm going to drag another low or another line right there. So I'm looking at this area of support and figuring, okay, 2,950 to 3,000 is going to be a pretty key area for the S&P. If it doesn't hold, I think there's a decent chance we're going to go all the way down to test this price support or get close to it, which also comes close. Maybe you get a tail down to 2,800 and come back up and hold that 2820 area. And that to me would be an indication of this lower trend line channel. Now, if we break down below 2,800, then we've got some things to consider. I mean, that to me would begin to definitely show a more bearish slant, because then what you could be looking at is a trend line that starts losing the slope. And then we're going to have to adjust this one up here. Whoops. So maybe at some point we're going to get another high out in here somewhere that maybe would coincide, you know, with this down here. I don't know, something like that. But right now, I'm going to ignore this, and I'm going to basically just drag this back down here. And I'm going to look at this basically as the channel. So we got futures up a little bit. We'll see 3,029.50. I'll give it a little bit of room here to the downside. If we can't hold, then I think we have to reevaluate the S&P. But this is what I'm looking for in terms of the S&P. And what I will tell you also is that historically, if historical tendencies mean anything, then we are likely to see a bounce from here as well. Since 1950, the S&P 500, if we look at June 28th to July 17th, and this is not just this particular month, but every period from about that time, the 28th of the prior month to the 17th of the current month, when you're heading into earnings season, the 28th of the month before earnings season to the 17th of the month of earnings season tends to be very bullish. This is where we tend to get a pre-earnings run higher. So June 28th to July 17th has an annualized return of 25.13% over the last 70 years. And that's 20 days a year for 70 years. So that's 1,400 days, which is the equivalent of probably 5.5 years of trading. So if somebody said that, hey, over the next 5.5 years, you could, average making 25.5% or 25.13% a year, you'd be pretty darn happy. That's a really good return. That's the equivalent of what this period, June 28th to July 17th, has done since 1950. So the market has a tendency to move up into earnings season. Whenever I talk about a pre-earnings run, some of these companies I think could have a pre-earnings run. That's what I'm talking about. Historically, the market goes up. Now, if the overall market goes up 25%, it makes sense that there are going to be some leaders that we might, on an annualized basis. I mean, again, it doesn't mean that I think the S&P 500 is going up 25% in the next 2.5 weeks. That would be crazy, or 3 weeks. That would mean the market's going up 750 points on the S&P. No, that is not what I'm saying. Don't misinterpret this. This is an annualized. This is taking 20 days, calculating the return, and then projecting it out over 253 trading days. Actually, take that back. It's projecting it over 365 calendar days, because we're counting the weekends from June 28th to July 17th. So you're projecting to come up with a annualized return of 25%. I'm spending a little bit more time on this because I always get emails telling me it makes no sense that the market can't go up 25% in 2.5 weeks. It doesn't do that. That's not what I'm saying. Annualized. You got to take these 20 days. So basically it's taking 20 days divided by 365, which is a little more than 5%, and multiplying that times 25%. So it's probably about 1.25. The S&P probably averages going up about 1.25%, which would be about, 35 to 40 points. So if this was just a normal year, come July 18th, the S&P probably would be up closer to 3,050. But again, that's an average. Some years you're a lot better, some years you're lower, but that's still much better than what we normally see on the S&P 500. So I just want to point that out. So if we were to bounce from here, or even if we went a little bit lower this week, but if we were to bounce from this area, that to me would be kind of fit with what we typically see historically. All right, I'll go through some of these other charts much quicker. I just wanted to spend a little time on the S&P there. All right, so let's take a look at the NDX, which is the NASDAQ 100. NASDAQ 100 talked about this shooting star. So that's a reversing candle off of an uptrend. and higher prices, lower PPO, negative divergence. So we kind of warned a little bit last week that when you see this, this can be a short-term issue. We've seen the NDX move lower. You can look at this. 3 days in a row of lower lows and lower highs. That's a downtrend. We're in a downtrend right now on the NASDAQ 100. Now, we have not had a close below the 20-day. We were 1 point higher than the 20-day on Friday at the close. We have not had a close below the 20-day since back in early April. That would add a little bit more technical bearishness if we have a down day on the NASDAQ today. And the NASDAQ in pre-market was down a little bit, even though the Dow, last time I looked, Dow futures were up about 100. NASDAQ futures were down, I don't know, a dozen points or something like that. So let's watch that. Let's see if we break down. And that's why I'm thinking, if we do, that could lead to a little bit more rotation. This is weak, but the S&P, which needs to hold support, might bounce back up. It's the rotation. So now you got folks looking at the S&P hitting support and knowing that we got a negative divergence on the NASDAQ, maybe we see a little bit more weakness here while money rotates back over into the S&P and the Dow. And that's why I was saying when I mentioned Boeing that we could see maybe a little bit of money rotating back toward those stocks this week because of the way the technicals are aligning. I wouldn't bet against the NASDAQ though. I mean, I would not short it. I mean, if you're going to hedge, that's one thing, but I would not be an outright short in this market. Technology. The one thing I'll say about technology, because usually when you see the NDX, kind of the XLK is doing something similar. You can see that shooting star on the breakout, negative divergence. But one thing that was interesting on Friday is that XLK did not put in a lower low. It also was a little bit higher than its 20-day, a little bit more room between its close and the 20-day. But very similar to the NDX, we had just that one close there on, looks like April 21st, that was slightly below the 20-day, but otherwise, the XLK hasn't closed below its 20-day since early April. All right, let's take a look at the XLC. I mentioned communication services, top of the show. There's your breakdown. We never really even had, I mean, we tried to get this breakout, never even got the breakout. And if you look back across here, in February, we had a high around 57, a little over 57, never could quite make it. If I go back to the technology group, this is the group that broke out above these prior highs. You can see 105 and change. Here we only got to about 102 or so. So technology made the breakout above the February high. We go back to the XLC, we did not make that breakout, but we were still strong. But now we've lost the 20, we're testing the 50. Facebook and Twitter, well, before I get into that, I'm going to show you the broadcasting group. We'll come back and look at Facebook and Twitter in a second. So broadcasting, got some areas to watch here. There's gap support, top of gap support here. Here's bottom of gap support. I think we're going to find something in this range. I mean, worst case, maybe we go back down here. We've got multiple tests down around the 1200 level. I don't think we're going to go there. I'm going to get rid of that. I think we're going to be somewhere. I think we're going to rebound somewhere in this range. And part of the problem, well, big part of the problem with the broadcasting and entertainment group is Disney. So with Disney, you can see almost the same thing, except Disney's all the way down at the bottom of its gap support. So Disney is underperforming the broadcast and entertainment group as a whole. So it's leading it to the downside. And I'd like to see a reversal here. If we don't get a reversal very quickly, I think we're going down to test this 100 area. You can see the PPO's gone negative. If this is the day, I think Disney really needs to make a move today, especially if that money is rotating back to areas like Boeing and some of the airlines and so forth. I would expect Disney to also see some of that money. So if Disney, if the group goes up, if the stocks that struggled during March, April, if they all get a little bit of love this week and Disney can't go up, that would be a really bad sign. So if money's rotating into that area and it still doesn't move, but this is a key area. Gap support is a key area. You can see the heavy volume that came in back on May 18th on this gap up, and we came right down to test it last week. Getting back to the internet stocks, let's take a look at Facebook. Facebook, huge sell-off. We were up over 240, 245, down to 216 in a matter of 3 days. But a lot of these social media companies are under a lot of intense pressure. Twitter actually topped back on June 8th at $37. It's now $29. It's lost just about every key support area that I can find. And even, when I look at that trend line that I talked about, I think the uptrend line here on the upside was pretty strong. I think if we just go right along there, you'll see multiple tests. That's pretty clear. So what I look for is a channel. Well, that's been broken. I mean, we'd have to go all the way down to this tail, and that's been broken from here. I could estimate the line being extended, but something like that. But it broke down, and that volume's heavy. So I think you got to be careful with Twitter, Facebook, especially Twitter. And that's going to put pressure on the internet group, which has been one of our leading groups. Now that it might just be the social media area, we're going to have to watch the rest of the area of that particular industry group. But Facebook and Twitter not looking very good. All right, let's keep moving on. How about the Xlf Financials? I'm going to do the same thing. Let's look for a channel here because financials, part of the area of the market that really hasn't been doing well the past couple of weeks. And this is the group that struggled back in March and April on a relative basis. Actually, I'm going to make this line bigger so I can connect the other. All right. And so then you come down here and take a look where we are. Getting pretty close to this area. And again, I'm going to draw these gap support levels right about there and there. So here's your gap that had not been tested until Friday. So we're backfilling this gap. We could go as low as 21 3/4. Beyond that, I'd be really careful. And I'd even want that to be an intraday tail where we come back up and we hold on to this trend line. So right now we're okay. Financials are in this channel, but this is the area where I would expect them to bounce from. Getting back to that theme, okay, money could rotate a little bit away from some of these NASDAQ stocks that have been strong because we're getting close to technical buy levels on some of these other areas that have not been performing well. So if you're bullish and you're thinking, okay, in a bull market, we simply rotate. You don't have a massive sell-off. In a bear market, everything goes down. In a bull market, certain areas will go down and money will rotate. Money doesn't come out of the stock market. It just rotates. And so that's why, again, this is an area that we want to watch. And I'll be honest, I'm going to try and take a couple minutes here, but I think our weak AD chart list, which has been underperforming the last few weeks, I think that is a chart list maybe that gets a little bit more attention on the long side this week because of what I'm showing you here. Next up, I'm not going to annotate because it looks very similar, but here's your industrials. There's your tops. We could do the same thing with the channel. You got the gap area right here, very similar, testing the top of the gap, testing the 50-day. So the XLI also, all of a sudden now Boeing getting a little love this morning, big part of the industrial group. Let's go to healthcare. I mentioned that technology was the group that had broken out. Healthcare almost broke out. And if you look at March and April when everyone was worried about the pandemic and whatever, a lot of folks still very worried about the pandemic with cases still rising. But in the early stages of this was the group that bounced back the fastest. Look at this versus the XLF. See the XL, you see the difference? Big move down, barely bouncing back. XLV bouncing down, coming almost all the way back in April. Now, there were a lot of folks jumping on board this area back in April, and I know it gets frustrating. Traders have a short-term memory. A lot of times traders don't put things in perspective. I try to keep things in perspective. Looked like the XLV was breaking down in mid-June. Technically it was below the 50-day, below the price lows. I mean, it looked like it was just going to go crashing down. And then when we saw everything else pulling back the last couple of weeks, money rotated back into healthcare. Watch this really closely because if healthcare makes this breakout heading into earnings, I think that you're going to see some of the best earnings reports coming out of this group. Right now, we're just sideways consolidating, but let's not forget how fast this group came back up in March and April. It was That along with technology, these were clearly the two best areas. Technology has continued to move a little bit higher. Healthcare has struggled more on a relative basis these last couple of months, but I think it's sideways consolidating. I'm looking for a breakout here still. And one of the reasons why I'm looking for a breakout is biotechs. So the biotechs coming off this low, look how fast. In April, mid-April, we were setting new highs. Already cleared February highs in mid-April. And this group kept moving higher, but look at the PPO, negative divergence. So what did we do? We went back, tested that 50-day moving average. PPO got close to the center line, didn't quite get there, and then we go up and we break out again with the PPO starting to turn up. Now we came down on Friday, but look, we're holding that 20-day so far. This is an area to watch on biotechs. If we keep holding this 20-day and we break back out again, I think biotechs could be the catalyst for healthcare. And I actually like biotechs a lot. I've got quite a bit of exposure to the biotech group right now. I think this is one of the strongest areas in the market. Also, medical equipment is going to be interesting to watch because this is one of the reasons why the group is not going very well. This was a strong group back in April, and here's your sideways consolidation. But notice every time we get down to about 1930 or so, we hold. We got a lot of support here around 1930. Finished at 1960, but the high was up at 2080, 2085. So I think we got a lot more room to the upside than risk to the downside. If it breaks down below 1930, 1925, you can keep your losses to a minimum. So I think medical equipment stocks, probably a bunch of those sitting out there right now that look pretty good. All right, let's move on. I want to just show you this week AD chart list for just a minute or two. So this has a bunch of stocks. I mean, you can always go in here to edit to see how many stocks are in here. But we've got 268 stocks in this week AD chart list. So if the money is rotating back, what should we look for? Well, I mean, it depends how you want to play this. If you're looking for groups that have been beaten up the most, you can go back and look at over the last week. And you can look at some of these stocks that last week got hit so hard. Look at their scooters. These are the stocks that maybe have room back, maybe have the most room back on a rebound, but they are not healthy stocks. So if I looked at any of these, it is a quick trade. If I can make some money over a day or two or three, I'm in and I'm out kind of a thing. I'm not holding these waiting for their earnings to come out. Completely different strategy than what I would be looking at with the strong AD or the strong earnings chart list, or even the new chart list that we have, the strong future earnings chart list. Those are all what I would say bullish stocks in a secular bull market. These are the weakest stocks. This is not where I want to park my money for very long. So I'm talking very short term. These are some of the plays that might get a quick bounce. Now, if you're looking at something in this list and you say, well, I want to find something that maybe has turned the corner and is maybe a little bit better than these really bad, pull up the scooter. I mean, here are the stocks. Look, there's a home builder. Here's a home builder. I mean, the home builders are, again, one of the areas with low interest rates and the economy picking back up. So there's a reason why these stocks are showing more, better scooters. So on the weak AD, the stocks that were doing really poorly back in March and April, these are maybe some of the stocks that I would be thinking, maybe I need to take another look at them. Maybe they've turned the corner. I mean, look at Gap last week, up 13%. Definitely doing better. And when you look at the weekly performance, this one's down 10%, but the top 15 stocks or so, that's the only one that was down 10% or more. Yet there were a lot of stocks that were down more than 10% on this list. So the high scooter weak AD stocks is a different angle to take. All right, got to mention Micron. Micron reports its earnings today after the bell. This is going to be pretty important for technology, for the semiconductors. Now, Wall Street's telling us not to expect a lot. Here's Micron relative to the semiconductors, moving lower. Micron relative to the S&P. It hasn't been able to get to a new high relative to the S&P since back in January. So this is not one of your best stocks in semiconductors. I would be much, much more interested in something like NVIDIA, which has been one of the best stocks in the semiconductor area. But still, this a lot of trading is going to occur in the semi space based on what Micron has to say. So when I look at this chart on a annotated basis, what I would be looking for, I mean, you've got some, I don't know, something like that. Actually, probably even more like that would be your trend line. So you want to kind of watch that. Recent support, recent lows right there. So I don't really want to see it go down too much with earnings. If it gaps down, I want to see buyers come right back in. If it gaps up, obviously we're holding that trend line, and that would be much more bullish. The other thing, if you want to, again, look at channels, then you might say, well, maybe it has a little bit more room to the downside, because if we take that high and we come in here, we could say, okay, there's a pretty good channel. So maybe we do have a little bit of room to the downside below this price support. There's also a little gap support in here as well. But I'm going to say if you go down below 46 on Micron, and especially if it starts selling off hard below 46, that's not going to be a good sign. But one final comment I'll make here is if I was going to be in semiconductors, it would not be in Micron. I just don't think Micron is, it's not one of the leaders right now. Maybe that'll change with earnings, but right now it's not one of the leaders. And so if we get out of here, market's opened, we'll see where it is right now. Yeah, just kind of sitting right there. All right, the 3 you must see. What I wanted to do with the 3 you must see, these are the top 3 scooter ranked stocks right now: large cap, mid cap, small cap. So I'm going to show you what these 3 stocks look like. Dexcom, this is in medical supplies, again in that healthcare area. If healthcare does well, watch this stock. I expect to see a breakout. I think 425, you can almost see move up, not quite up to the top here, but a little bit like a cup and a handle coming back down. This is one that I certainly would be interested in. Let's see what it's doing today. It's up just a couple bucks. But this down to the 50-day, you can see we really haven't closed the last few months below the 50-day, and it's almost down testing it there. So DXCM still looks good. Zoom, the top scooter score among mid-cap stocks, just keeps going higher and higher. Down a couple bucks today, but honestly, with the way this thing's been going, every time it pulls back, for the most part, it's been a buy. And the last one is Novavax. Now, this one is a stock. I think that they've got a drug that's before the FDA right now that's Theraflu, but they also are trying to develop a vaccine for the coronavirus. So they got a couple things driving this stock right now. I'm not even going to tell you how awful I feel. I owned the stock back in March or April. I don't remember how many shares I had. But it was one that I really liked, and mostly because as it was going down, we got the AD line that was still going up. And it was located in Maryland, close to where I used to live. I'm somewhat familiar with the company. And needless to say, I didn't hold it. Would be feeling really good. I mean, there have been so many times I probably would have sold it anyway. But, fantasy world, I would have held it from back in March till now and been on an island somewhere this week. But that didn't happen, so I'm instead with all of you here on Zoom. But Novavax's been a great performer. This is the top performing small cap stock, and you can see why. It's been a leader in the biotech space. Hard to chase a stock that's at 78 when it was at single digits 4 months ago, 3 months ago. But this one's been a great performer. All right, quick update on the market, see what we're doing, and we'll wrap this thing up. Right now, Dow's up 213 points, S&P up 12, and the NASDAQ 100, you can see down 6. So there, we are starting the week with that little bit of rotation. And you can see also Facebook and Twitter both leading the S&P 500 down today, so the pressure remains there. Everybody have a great day, and I'll be back tomorrow over at Stock Charts TV for another episode of Trading Places Live. Take care, everybody. Happy trading.